Okay, we are back with Karl Berger. He's our featured guest. He's senior wealth consultant at Cidel Asset Management. To talk more broadly about the markets, we went through Karl's bear market checklist in our earlier segment. One factor that you think applies to our current circumstances right now, which could be flashing a bear market signal, is the Trump presidency and a very aggressive U.S. Policy towards its neighbors. I think you're talking about tariffs, among other things.
Yeah, so let's think about it from a couple of different perspectives, Paul. And yeah, the 5 bear market indicators that we talked about, mostly benign, not overly concerning, other than maybe the inflation one in the U.S. The uncertainty around where the U.S. is going from a policy perspective these days has to weigh on people's opinions if you're talking about conditions that could prompt volatility. There's an awful lot about Trump's agenda that would be pro-business, and those things you've talked about, I'm sure, over and over on the show over the last couple of months since the election. Some of those things could be very, very pro-market. It's hard for me to imagine that the uncertainty over international relations and international trade, how is business going to work with the U.S. and with other countries? I can't imagine that that's not playing on managers' sentiments in really all of the developed world. Mm-hmm. And at the very least, slowing investment and allocation decisions. I don't pretend to have a clue how hard Trump will go on tariffs and all those sorts of things. I think generally businesses are pretty good at evolving and dealing with those sorts of things. Mm-hmm. And we've already seen a reaction in the Canadian dollar, for example, since the talk of tariffs came in. So there are other things that then offset the impact of some of those things. In general, we're talking to clients about it being a reasonably, it's an interesting market for sure. There are some uncertainties. Absent any significant shocks to the system, I like where we're at from both a valuation perspective, from an interest rate perspective. Even in Canada, interest rates have come down significantly, but as we talked about in the very first segment, wage growth is still solid, hiring is still solid. There's not too many reasons to be upset from an economic standpoint. So
for your clients, then, this means that they stay on their equity targets that they've set. You're not recommending under or overweight equity positions compared to or based on the allocations that they've agreed to.
That's precisely where we're at. We don't feel like we want to take less risk than we've agreed to with clients, but there's probably good reasons not to take more risk. The kind of ironic thing about the way everything is setting up is that one of the riskiest things that people could be doing, maybe from a purchasing power perspective, is sitting in either Canadian dollar cash or Canadian dollar fixed income, because neither of those asset classes will have any role in protecting purchasing power in the event that the Canadian dollar was to weaken significantly, and that's not impossible.
That's Karl Berger. That's how he sees the markets. His clients have full equity weight positions.